Good afternoon, everyone. Welcome to today's weekly market insights. Now, as we have a look across to the calendar, we can see some labour market figures out of the UK. Claim account change in the UK is pretty similar to the initial jobless claims out of the US that we get each Thursday. So we had a decrease in the amount of unemployment claims out of the UK in regards to last month. Still a drop, which is positive. A little bit less of a drop as to the previous month, but still kind of positive figures all the same. We see the unemployment rate has not changed, so only a small increase in the amount of unemployment claims of the last month, but the unemployment rate has remained the same, which we will need to keep an eye on going further. Now, as we come across to the Wednesday, we see CPI inflation figures out of the UK slightly positive, which you would imagine we'd see some sterling strength off the back of that. But in today's day and age, where inflation is high across global economy, across nearly every country apart from China, as we can see above, a slight miss on inflation. But as we come back to the UK and many other countries around the world, inflation is rampant, and it is pretty expected and in line with markets' expectations to be a little higher than the market consensus. So we did not get much of a move across those figures throughout this week. You can see inflation out of China, which has been relatively subdued compared to its counterparts around the world, remains subdued over the month of January in terms of the year-over-year figure, which is at 0.9%, which is considerably lower than other major economies around the world. As we come across to the minutes, the other bit of data, really main piece of data throughout the week, was the minutes. Now, the Fed did show a willingness to hike interest rates at a faster pace than markets initially expected. But on the flip side, on the other side, there's articles, multiple analysts throughout the week are seeming to push back on the 50 basis point Fed hike in next month's meeting, in the March meeting, which was originally being talked about in markets as being priced in an expectation for a 50 basis points rate hike. But markets seem to be, over the last week, dialing back those bets on a more hawkish Fed. Still got a hawkish Fed, but maybe not as hawkish as initially feared. As we come across to the charts and have a look at what is going on across the charts, we can see in the US government bonds 10-year yield, the yield on the US 10-year has made two attempts over the last 2 weeks at this 2% figure. Now, we can have our opinions and theories about to what should happen in the future, and if on face value, this should move higher in the future with the Fed on a hiking cycle, removing their stimulus measures from the markets over the past number of months to finish in March, to then go into a hiking cycle, a hiking of interest rate cycle. Now, this has had made two attempts at the 2% figure. We ended last week with a gravestone doji. We're in this week with a kind of a gravestone doji shooting star sort of candlestick. Now, does this say that we're going to have, a pullback, any sort of a downtrend? No, you would imagine this does go higher and continues higher over the coming weeks and months. How higher is yet to be seen, but you would imagine this breaks at some point. But for the moment, this 2% figure on the 10-year yield is being defended, and it's definitely something we need to keep an eye on going forward. It doesn't look like we're going to get a weekly close above that level, and as long as we stay below 2%, you would imagine that the dollar does not appreciate too fast, too quickly, or too far, too quickly, should I say. Now, the calendar this week was not the main focus of attention. Main focus of attention was still on the Russia and Ukraine situation. Now, we had rumours out we had a statement out earlier on in the week from the Russian Defense Ministry suggesting that Russia are pulling back from the Ukraine border, and there was a little bit of positivity throughout markets during the week. But we can see this move higher, bring it down to a little shorter of a time frame, we see this move higher here, which was off the back of that headline. We have since chopped sideways and moved back lower once it has been, well, it was suggested that earlier on in the week that what the Russian Defense Ministry has said, that they were pulling back from the Ukraine border, was actually not what was happening, and it has since transpired that they have not pulled back as much as markets obviously would hope. So we've ended up back where we started, and we're still waiting fresh catalysts. We're still waiting fresh headlines in order to decide what way we are going to take this. Both sides seem reluctant for a war. Russia state that they are not looking to invade Ukraine. The UK and the US suggest that they think somewhat differently. So we can't really work based off of these headlines on the different news releases, on the different news sites. We need to wait for some clear facts, some cold hard facts, in order to make our decision on whether we believe that Russia will invade Ukraine, and then that will in turn put another negative stint on equity. So everything's a bit choppy this week, a bit of a difficult week in terms of trading conditions. We are a bit undecided on whether Russia are going to invade Ukraine. Markets seem a little bit undecided as to what the Fed are going to do next month. So markets have been on a bit of a holding pattern this week. Apart from over here, as we can see, the Kiwi, which has continued to truck higher over the course of this week. Now, as we come back to the calendar and have a quick look across to next week, just give me a second and we'll pop up next week's calendar. What we can see here is the RB&Z and their interest rate decision, rate statement and monetary policy statement coming out next Wednesday. Tuesday night for us here in the UK, Wednesday morning for people over that side of the world, followed by a press conference an hour later. Now, they are expected to hike interest rates again from spot 7.5% to a full percent. Now, arguably the RB&Z are arguably the most hawkish of the 8 major central banks. They were the first to remove their stimulus measures. They were the first to remove their asset purchase, and they were also the first to hike interest rates. So there is definitely a case for them to be the most hawkish of the G8 central banks. They have the highest interest rates of the G8 central banks, and those rate differentials can definitely play a part in looking to trade the Kiwi going forward. Now, is the US dollar the best pair to trade it against? Possibly not, but as long as that US 10-year yield remains below 2% and we do not continue higher in regards to the US 10-year yield, I think Kiwi against the dollar, Kiwi as I like to call it, should in theory keep moving higher as long as the RB&Z stick to the script next week. There may be other better pairs to trade it against, maybe other better currencies. It could depend on what the indices are doing in terms of that whole risk on, risk off profile. Ideally, I'd like to trade the Kiwi against something like the US dollar. Ideally, the Japanese yen, even the Swiss franc can be an option too, but you would want indices also moving higher off the back of that. So the cross-asset correlations are a bit confused at the moment. They are breaking down over the last couple of weeks, so it is pretty difficult to isolate some clear direction. Now, the RB&Z is the main focus of attention next week. We have GDP, a couple of figures out of the US, and we also have President's Day on Monday in the US, so we are likely to have relatively limited liquidity across US markets on Monday. We've also got the PBOC with our interest rate decision early doors on Monday, Sunday night for us, Monday morning for us, and that remains to be seen what they decide to do off the back of that. So relatively quiet week in financial markets this week. Difficult to pinpoint some direction, difficult to figure out where to take some asset classes, but this type of week, it can be good to keep your money in your pocket. Wait till you get some clear direction, wait till you get some certainty as to what is going on, and then you can look to hit a couple of different assets. So hopefully a bit more action next week, hopefully a bit more clear cut direction. Be waiting in anticipation for that, and we will be back next week at a similar time for another weekly market insights. Thank you.